and welcome back to Sibos TV. I'm Daisy McAndrew, broadcasting live here from the Boston Convention Center at Sibos 2014. Very warm welcome to you. And if you did run the 5K fun run, the Sibos fun run this morning, then we take our hats off to you here on the Sibos TV team. Many congratulations. Now for the next 45 minutes or so, we're going to be delving into everything regulatory. It's been a big subject here in Boston this week, and we're going to devote quite a lot of airtime this afternoon to it. First of all, we're going to start off by hopefully demystifying some of those regulations. I'm joined by two experts. To my right, Hester Pierce. Hester, welcome to the program. Hester's a senior research fellow at the Mercatus Center at George Mason University. Research interests relate to the regulation of the financial markets. She's also serving on the Investor Advisory Committee, which advises the Securities and Exchange Commission. So thank you for finding the time,
thank you.
Hester. Stuart Weinstein is Professor of Practice-Informed Legal Education and Head of Coventry Law School back in the UK. Stuart, you're an expert on international business law with an emphasis on legal risk management, governance and compliance. So I couldn't have two better guests to answer the question, or the plea really, to demystify. Stuart, if I can start with you, who would you say are behind these various pieces of regulation?
Well, in each country we have different regulators, and in particular we have a set of regulators governed by the European Union in Europe, and then of course in the United States we have the Securities Exchange Commission and the Commodities Futures Trading Commission. So that's the basic split between the U.S. and European Union in terms of transatlantic regulation. And then other countries, of course, have their own regulators: Australia, Singapore, China, Japan. So the issue is, how do you get everyone singing from the same hymn sheet?
Well, exactly, and we'll come on to that in just a moment. But Hester, what do you think are the regulations that are causing the most pain at the moment?
Well, I think tying into what Stuart just said, it's about, rather than specific regulations, it's more about getting everyone singing from the same hymn sheet. And so even within the US, you have quite a bit of tension between the SEC, the CFTC, and the Fed has gotten more involved, and now we have a new grand overseer, the Financial Stability Oversight Council. And then you add to that you have the relationships with foreign regulators, and so we have a lot of tension right now between US and European regulators, for example, and I think that that's an area where a lot of the concern is coming, because a lot of the industry participants say, just tell me what the rules are that I need to play by and I'll play by them, but they're very uncertain.
But the funny thing is that just in the US, the SEC and the CFTC, they disagree on the definition of what a US person is.
But, well, exactly, and if you can have such fundamental difficulties between two, you would have thought, quite harmonious groups, then what possible chance is there globally?
That's right, and that's part of the problem. The good news is that the G20 will be getting together shortly in November, and if resolution isn't had before then, resolution will be had at that point. And that's
you sound
hopeful.
Very confident of that, Stuart. How can you be so confident?
Because the G20 got us into the situation in the first place. It was about 5 years ago. But I think that at that level, where you're at the heads of state level, much more can get done. And I think that's the hope.
But I'm less confident than Stuart, I have to say. And I'm less confident because I agree there'll be an agreement among the G20, and then they'll take it back to the regulators, and the regulators will start causing trouble again.
I mean, I know we can't go back to square one and tear up what we have and recreate the perfect system, but let's say we could. Let's say we were three financial gods and we could start again. I don't think we would be starting from where we are now, would we? What would this perfect system be, do you think?
Well, a perfect system that I would design would have a lot less government regulation and focus a lot more on getting market participants regulating one another, which would mean that if there were a problem, then the person who caused the problem would bear the loss. So that's how I would design the ideal system.
I think from my point of view, the magic word is substituted compliance. If I'm a US business and I comply with all the rules of the United States, that should be good enough for Europe and vice versa.
But isn't one of the problems, as we've already mentioned, political, in that the financial services industry is very important to some countries and it's not very important to some other countries, and therefore the politicians in those countries will treat them quite differently. One will be very protective towards that industry because it's the golden egg, or the goose that lays the golden egg, and other countries won't. So you've got different tensions in different countries, and they're never really going to see eye to eye.
Yeah, and I think complicating matters now is just this very public dislike and distrust of the financial industry, and the politicians love to play that up. And so on the one hand, they're trying to protect their own industry, but on the other, they're bringing these big enforcement actions, and that also adds a new element of uncertainty.
Yeah.
And I think some of the fault lies also with the lawyers, for lack of a better...
Do you mean lawyers and lobbyists, or lawyers?
Lawyers in particular, I think lobbyists too, but I think in lawyers in the sense that a lot of the problems that arose in the financial crisis was that when there were certain types of, and also the accountants, by the way, when there were certain types of transactions or certain types of bookkeeping that couldn't be done in the United States, the banks would go to, say, London and get an opinion from a legal counsel there and accountants and do something that they couldn't do in the US. And that really caused significant problems in terms of the breakdown of Lehman Brothers as well as AIG with the whole AIG financial products company. So the US government's very keen to crack down on that. They want to crack down on financial events or things happening overseas that affect the US market. So I can understand that point of view.
But at the same time, in the AIG case, I think is a great example because we had a problem in AIGFP in London, but we also had a problem here in the US with the US regulated insurance companies. And the American regulators don't like to talk about that one so much.
Yeah, that's true too.
Now, we've mentioned lobbyists, but if you do want to influence, if this industry wants to influence these policies, what should they be doing?
Well, I think that they need to talk to regulators, and one of the things that we discussed earlier this week on our panel was that it's really important to get the people who have to implement the regulations talking to the regulators, so we need to have the technology guys in the room with the regulators to say, yes, you can tell us to do this, but we are going to have to put this into place and we're going to have to code it, and that's going to mean something very different at the end of the day. And so getting those people involved early in the conversations would be great. I know that in the US, at least, I can say that legislation is made without any consideration of how it's actually going to be implemented in the details down the road.
And I think there's been a lot of talk this week about collaboration, and particularly if you're trying to influence either policymakers, political policymakers or regulators, collaboration as an industry and speaking with one voice must be absolutely crucial.
That's right, and one of the issues that one of our colleagues, Michael King, pointed out was that it's not good enough for a banking organization to rely upon a trade association, because the trade association has a very large umbrella. They have to represent the entire industry. Yeah. So as a result of that, they can't really cover the niche points that individual organizations will have, the special concerns that they will have. So you really can't just say, oh, I'm going to leave it to the trade associations. I have to take responsibility in my company for it.
But then I suppose what we've been seeing the other extreme, if you don't leave it to the trade association or the umbrella body, and you employ individual lobbyists to lobby your own bank's point of view or your own firm's point of view, you've got far too many lobbyists perhaps doing slightly different, asking for slightly different things. It needs to be a broader coalition than that, I'm assuming.
Well, I think that's what drives people to use these broader coalitions, but I think that the point that Michael King was making, which I think was an excellent point, was that you need to bring people into the room who are really pretty high level in a particular firm, and they need to get involved rather than kind of offloading it to a lobbyist, which again is understandable, but you might not get the level of knowledge in the room that you really need to have in the room.
Yeah, and then you just have to start all over again.
Right.
Absolutely. Stuart, tell me about the research grant that you got from SWIFT. I think you've been researching around this area.
What in particular my research grant involved was the issue of over-the-counter derivatives and regulation in both the European Union and also in the United States, with particular regard to the issue of extraterritoriality. What was it? The expression is, some people say, well, the U.S. regulator sees the entire world as its territory and everyone else just has to lump it. And that's the issue that I was dealing with, is how far is too far? When is the U.S. overreaching perhaps in its regulation? And that's an issue that I've been dealing with and have been focused on the regulation. To me, it's an interesting question because, where does the end of U.S. jurisdiction, start and the rest of the world picks up? And I think these days the answer is that's not clear. Maybe Hester might have a view on that.
I think we're going to have to leave that question hanging in
Okay.
the air with a pregnant pause. But thank you so much, Hester Pearce from George Mason University and Stuart Weinstein from Coventry Law School. We're going to be sticking with regulation after this short break. Well, hello there and welcome back to Cybos TV. I'm Daisy McAndrew and we're continuing our chat here in the studio on all things regulatory, the regulatory avalanche. And I have 4 experts with me alongside me. Matt Nevins from SIFMA, welcome to the programme. Good afternoon to you, Matt. Justin Chapman to my immediate right from Northern Trust. Thank you for joining me. Mead Reynolds, you're from Brown Brothers Harriman. Welcome to Cybos TV. And Jean-David Larson from Russell Investments. Good afternoon, Jean-David. Matt, maybe I can come to you first. Sure. What exactly are we talking about, this avalanche? What does it contain?
A lot of regulation. So we're getting hit by all sides from both the United States regulators and the overseas regulators. As expected, really, in the fallout from the financial crisis in 2008, the global financial regulators have really put out quite a large amount of new rules, and it's been an onslaught for everybody. Investment managers have not been spared at all, and we had a discussion earlier today, and we'll continue that here, on how the investment management industry is dealing with this whole new onslaught of regulation that's coming at them, again, both domestically and internationally, how they're building out communication systems, oversight, making sure that they've got the right people plugged in. We used an example of transparency and new reporting rules, both coming out of Europe and the CFTC as it relates to derivatives, Solvency II, AFMD, the private fund regulations under Form PF. Then we talked about how there are conflicting rules to some degree amongst the US and domestic regulators and how investment managers are able to build out their systems and try to plan when there is a divergence among those regulators. We're seeing that in the clearing space where the CFTC has already rolled out their central clearing mandate, and now we're seeing the clearing requirements go into effect in Europe under EMIR. However, the CFTC has not yet recognized European clearinghouses as being equivalent, and in Europe, they have not done the same, partially because their law requires the CFTC and the US regulators to act first.
It is a ridiculously confusing picture, isn't it? Jean-David, do you feel as if you're being pulled every which way?
Absolutely. One of the things we talked about in the panel this morning is that the regulations are global, and so anyone who's doing work globally or for clients globally is being caught. The number of products that you manage, the types of strategies you run, the types of clients you deal with, and the jurisdictions all multiply your complexity by several factors. So I think one of the things that you have to do is be flexible enough to deal across those jurisdictions and have the capacity and expertise to do that. It's one of the challenges I know we and our entire industry have faced, and it's going to continue for the foreseeable future, so we all have to embrace the new reality.
All right, well, let's embrace the new reality. Justin, let's cheer ourselves up. Are there any silver linings to this situation? Sprinkle a little dust, a little starlight on it.
Absolutely. So I think with any significant change, whether it's market infrastructure, regulatory change, there is opportunity. I think you have to be positioned very well as an organisation, be agile, be willing to be open-minded, and also collaborate with a bit more with your colleagues in the industry in itself. So I think you need to look holistically across the different silos of the business, but not just at your business line, and really what does the client need from a regulatory perspective, and what's your counterparty's requirements as well, because the models will change. Different organisations will function in different ways, they'll operate in different levels within the current infrastructure and current value chain. So as things change, I think if you're agile, you consult well, and you've got the right investments and the right strategy, there will always be opportunities, because there will be other organisations that don't quite adjust to the opportunities that will come through.
Do you think that there is that love in the room, that collaborative feeling? Because it must sometimes go against the grain.
I think historically it would have gone against the grain, but I think you've seen at this particular event a good direction in that collaboration, and a lot of announcements where different organisations are joining together to come up with solutions across the piece for the client. And I think that's a really important element. I think we'll start to see that trend moving forward. I think organisations won't be able to offer the current product suites because of capital constraints and liquidity challenges. So as those adjust, I think they'll find natural partners and organisations that can fit together to offer the end client and the end investor the products and services they need. So a bit of a new dawn, but I think there's certainly opportunities here. And as Northern Trust, we certainly see those opportunities to work with and collaborate with other organisations.
It is interesting, Mead, isn't it? It is a new dawn, and different people are going to slot into it in different ways.
That's right. And again, looking at the glass half full, to follow on Justin's point about opportunities, we do think that the regulatory environment doesn't need to be a bad thing. If you embrace it and say it's the new norm and have confidence that at some point the regulatory environment globally will be harmonized and there'll be some ability to have common standards and best practices and the cost and investment will be moderated, then asset managers do have an opportunity to look to maybe the more conservative investors who whether that's a retail or an institution that is a little bit more risk averse, but embraces and welcomes the regulatory environment and says, this is maybe a safer haven for me. I will step off the sidelines, dip my toe into the water and invest in this asset class. So there's some opportunities there for some new investors.
Jean-David, have you seen that perhaps the new investors are slightly more conservative, as Mead was saying, and that, that's sort of a new reality?
Yes, I think the first thing you're seeing is investors extricate a little bit out of certain products. And that's natural because those products have always been complex and they're being asked to do more and more as a client than they did before. Before that used to happen behind the scenes, that happened by the market intermediaries, the asset managers, the asset servicing providers, but now clients are having to shoulder more of that burden. So over time, I think that will shift, but in the meantime, that's putting a lot more burden on clients, and until they fully understand what that means to them and how they're going to manage their risk, I think they're rightfully being somewhat tepid. And then other clients who are more well-resourced to move quickly are taking advantage of those opportunities now.
It's interesting that mention of education, that it takes the experts in the field a long time to work out what the new regulations mean, let alone educating customers and clients about what it all means. And then just as you think you've got your head around it, everything changes, or so it's a constant educational process.
Yeah, there's no question about that. I mean, that's one of the reasons that we use the word avalanche. It doesn't end, and it's continuing to keep coming. We're continuing to see more and more out of the regulators, new regulation, new areas that they're focusing on. And that's something that we do as a trade association at the SIFMA Asset Management Group. We work with people like Jean-David at Russell, working with our members on educating them on the new requirements and how they can evolve their businesses in this new marketplace as the markets themselves react and respond to the new regulations that are coming out. So then Jean-David can then turn around and educate his clients that he works with to make sure that we're all harmoniously working together to the fullest extent possible as the financial landscape changes.
Well, I suppose the point of the regulation, one of the many points of the regulation, apart from a sense of slight punishment, which is what a lot of people feel, is that it's about trust, and it's about the regulators, putting in place a new system whereby people can trust that system. But there's so much mistrust around for a lot of it. It's very difficult to see when we're going to get to that nirvana.
I think there's certainly a lot of themes in regulation that we're picking up on. Obviously, systemic safety for institutions to operate with each other is very important. But at the end of the day, for the pension funds and us as pension contributors, asset safety is absolutely got to be key through the value chain. So I think a lot of the regulations, when you boil it down to core themes, whether it's asset safety, cost of ownership through the fund structured products, provision of liquidity and capital to support these products, actually, as that framework builds out and the products and services are demonstrated to tick those boxes, I think that should give some investors a confidence again in the infrastructure and the system. And actually, transparency was another thing we talked about a lot. And there's a lot of effort around providing transparency through that value chain, through reporting to regulators, but also to the end investors coming a common theme as well now. So hopefully, using that positive outlook, we can start to see the benefits of that kicking in.
Alongside that, trust is really investor protection, and it's hard to argue against the concept of investor protection and making sure that the proliferance of the alternative space is suitable for the retail investor in particular, and And so at the end of the day, we all would agree that that protection is a requirement. So it's just dealing with the avalanche in the short term is the challenge.
The short-term pain. Well, let's look forward to Cybor's 2015. Jean-David, are we still going to be sitting in this studio discussing yet more regulations, or do you think the tide will have turned a bit by this time next year?
I think we'll have iterated more through some of the things that have already come out, so I don't think you'll have as big of a second avalanche. I think it'll be a continuation of a slide, if you will. So we'll just have to navigate that. I mean, I think one of the things that will be interesting to see, sometimes it feels like we're in the middle of drug trials, but you're taking the live antibody without being certain exactly what it's going to cure and how it's going to cure it.
Waiting to see where the big boil's going to come.
Exactly. So I think it's an ongoing process. I think that's part of the challenge, is we're trying to move, the regulators want to move quickly, policymakers want to move quickly, so we're having to kind of test it as we go. But it's an industry that's having to test it, not a sample set or pilot.
Well, exactly. People do feel like guinea pigs, with this so much new regulation, and you're not quite sure what the unintended consequences of some regulations. Have you seen any bad unintended consequences so far?
I think so, but I think what I'd like to start off with, by saying is that not all of these regulatory change is necessarily a bad thing. In fact, we were very supportive of the need for some of these market changes that came out of Dodd-Frank following the 2008 financial crisis, and and indeed globally throughout the world. Rebuilding trust and confidence in the financial industry is a key fundamental point for, I think, all of us within the financial industry, certainly for us at SIFMA. And as asset managers, I work on the asset management side of SIFMA. Asset managers are the ultimate fiduciaries of their clients. So we take that role and responsibility very seriously to act in our clients' interest at all times. So restoring and rebuilding that trust and confidence is key. That said, yes, there are some unintended consequences. I think there's been some significant impact on liquidity. We're worried about market fragmentation, particularly, again, if we're going to see different rules that don't mesh well on different timelines between the United States, Europe, and in other Asian and other jurisdictions throughout the world. Hopefully, the regulators will be able to work together more harmoniously to come up with regulation where the markets themselves don't become divided, and there really truly is global liquidity as we move forward.
Okay, well, Matt, we're going to leave it on that semi-optimistic note. I think I can put it like that. Matt Nevins from SIFMA, Justin Chapman from Northern Trust, Mead Reynolds, Brown Brothers Harriman, and Jean-David Larson from Russell Investments. Gentlemen, thank you very much for continuing our discussion on regulations, the avalanche of regulations. Stay with us in just a couple of minutes. We're going to have yet more on this subject. Bye-bye. And welcome back to Sibos TV. We're continuing our conversation about all things regulation. And of course, it's not just banks who are affected by the avalanche, as we've described it, of regulation. Corporates are just as much. So to dig into that area a little bit more, I'm delighted to have been joined by David Cruikshank from BNY Mellon. David, welcome to the program. Welcome to Sibos TV. Carol Berndt, welcome from RBS. And Jana Bundy, very nice to see you, Jana, from Microsoft. And of course, as I've just been saying, it's not just the corporates who are struggling with this issue, is it? David, maybe come to you first. What do you think is going on in the corporate world? How have things changed as far as regulation's concerned?
Well, I think from my perspective, what we're seeing mostly change as a banker are regulations that are impacting banks, and then by extension, how they'll impact the corporate marketplace.
Yeah.
So as banks, we're being faced with regulations that are all well-intended and very often tend to be balance sheet led. So regulations around the asset side or liability side of a bank's balance sheet, and then exploring how that's actually impacting the decisions that banks take in their relationships with corporations. The flip side of that is that corporations then need to make decisions on their bank partners based on how that plays out.
And of course, whether it be fair or unfair, there will obviously be a suspicion that those extra costs are going to be passed on to the corporates.
Well, costs will be borne within the system, and that's a given. Will there be extra costs passed on to a corporate relationship based on impacts of costs on banks? I think that's a natural outcome. I don't think we're at the point of maturity of some of these regulations to understand exactly how that plays out yet, but with certainty we know there's an increase in costs in the bank ecosystem around some of the new regulatory practices coming into place.
Well, Jana, coming to you from your Microsoft perspective, how's the regulatory environment affected you? What differences have you noticed?
Well, for the past couple years, it has had significant impact on the Microsoft Treasury team as we look at the various regulations. So I could probably talk a full hour on the impact, and as I think about it, we've had SEPA, we've had Basel III, we have money market reform, FATCA, FBAR. I mean, I can go on and on about the impacts to a corporate treasury and the things that we need to think about. Top of mind for us is really, because we manage an investment portfolio, so a cash and investment portfolio in-house, we are really looking at OTC clearing and the impacts of that. And there are costs associated with that, along with understanding the regulation end-to-end across all of your teams. So we really look at the impact across our capital markets team, operations, our risk team, our legal team. And we've made a lot of changes the last couple years as we've begun to clear for Dodd-Frank, and we're thinking about the impact and implications of EMIR. So that's really top of mind for us. And what we've really seen from a corporate perspective is it does have a lot of impact. So you have all of these systems that you're trying to connect, having visibility to your transactions, and then really thinking about the cost of clearing versus not clearing. So those are the things I think that are top of mind for us. And then also, I know on our panel that we'll discuss this afternoon, Basel III, and as we think about the implications of that, of where we think about where we hold our cash and what we do with our cash as part of our portfolio.
Carol, listening to Jana there, I mean, she has so much in her entry which you wouldn't necessarily imagine a corporate would have. What's the role of the bank in sort of holding the corporate's hand, if you like?
I think there's a very extensive and important role there. I mean, what we've looked at doing is providing our corporate clients with information, planning, and then support in execution. Jana touched on SEPA. That was a very good example of where something that looked exceptionally challenging to the industry and to corporates became a relatively successful project, albeit we've got more to do as we came together. So it's the information and the planning and the execution support.
And Carol, have you noticed any difference in appetite for lending? I mean, obviously, for the last few years, there's been constant stories in the press about banks' appetite for lending being reduced. But in this particular sphere, what are your thoughts?
Certainly, the regulatory environment makes us look at the cost of resources. And just like any product that's manufactured, you have to sell and produce it relative to its cost of production. Now, capital is a resource that we never really priced appropriately previously, and Basel III forces us to do that. And as we do that, we look to our relationships to work out which ones are accretive both for the client and ourselves. That does mean lending is not as free as it used to be, but what it will result in is deeper relationships, fewer relationships, but much more valued relationships.
David, do you think these consequences were intended or unintended? And are there other consequences that we haven't mentioned yet?
Well, when we look at things like Basel or the U.S. extension on the SLR, the supplemental leverage ratio, I think the intended consequence is really in the bank environment. It's in the bank ecosystem. So was there an intended consequence to shrink bank partners or to reduce lending? My guess is there was not. Yeah. But certainly to make sure that we shore up the financial integrity of the system was certainly intended. But I completely agree with what Carol said. The impact of this is that there is a pricing mechanism now that didn't exist before. We always looked at things as banks, such as risk-adjusted return on capital, and now we're looking at the cost of capital without taking into consideration a risk adjustment factor, so we get an increased cost of capital against these particularly off-balance sheet unfunded commitments. And it's forcing banks, or I should say will force banks, to make some very difficult decisions as to which partnerships they want to continue to maintain. And it will, just as Carol said, shrink the relationship patterns, I think, that banks and corporations have together today.
Absolutely. Jane, I'd be interested to know your view of technology's position within all this. Can technology help corporates meet all these, that massive list of new requirements and in reporting?
Yeah, and one thing I want to comment on what David just said, because I also agree, or we agree from the Microsoft perspective that there will be impact to the bank relationships, and those will remain key. And I think it may mean that you work with smaller groups of banks, but I think we at Microsoft really value those partnerships with bringing information to us proactively about things we need to be thinking about. So the partners we look at would be coming and saying, this is what you need to be thinking about. We know your portfolio, we know how you operate your cash. Here's what you should be thinking about going forward of your impact to these reforms that are coming. As far as technology, clearly technology is key. It's very difficult to manage the infrastructure of what we need to do with all of the new regulation and having that visibility to reporting. So one thing that I will add is, I'll use EMIR as an example because there is delegated reporting that we highly rely on for our OTC, well, actually all of our derivative positions. And, coming up with some type of standard across banks would be very helpful. I might even bring that up as part of a SWIFT initiative that they should think about, because those are key, because we really rely on good reporting for that information. But for us, we couldn't do it without technology. We look at being able to operate, straight through processing for everything, timely confirmations, visibility to, our exposures and our collateral. So I definitely think that's a key component to be successful.
Interesting. Carol, just sort of coming to the end of our chat now, let's look forward a bit. What do you think, how are relationships going to be affected over the next months and years to come, do you think?
I think they are certainly going to become more transparent. I think trust and transparency are going to be the hallmarks of going forward. Historically, we've talked about transactions, and the regulatory environment forces us to be more open with each other, more collaborative with each other, both within the FI industry, but with our clients. And when we have trust and transparency, we have great transactions, and that's great for everyone.
David, finally, how far down the line do you think we are? Is there light at the end of the tunnel yet?
Well, there has to be, right? You don't put anything new in place without assuming there's light at the end of the tunnel. I'm not sure we're there yet, because I think a lot of the new regulatory pressures that are being put on from a bank perspective have not filtered into the corporate treasurer's office yet. The knowledge is there, but the impact, potentially the cost, and then how they reallocate their relationship has not really filtered through yet. So I think we're still a little ways away.
Okay, well, on that slightly pessimistic note, and of course, I guess one thing to add is by the time we are at the end of that tunnel, there'll be a new regulation for us all to get our heads around. But thank you so much, Jana Bundy, Carol Berndt, and David Cruikshank for talking us through regulation from the point of view of the corporates. That's it on regulation from Sibos TV for this afternoon, but we'll be back with a special guest in just a couple of minutes.